Hey everyone, welcome back to the podcast. I'm your host, Tom Shaughnessy. I help lead Delphi Ventures. Today, I'm thrilled to be recording from our WeWork office where I haven't been in like a year. And I have on Gabe Shapiro, who's GC of Delphi Labs, and I think one of the most well-known and knowledgeable legal voices in the crypto space. Gabe, how's it going?
Going well. Glad to be here.
Gabe, you look like you're ready for the weekend.
Oh, I always look like that. I work on my couch on a lap desk. It's great.
It's crazy how much you get done there. Well, Gabe, tell us a bit about your background for those who don't follow you.
Sure. So I've been an attorney for, I don't know, maybe like 11 years now or something like that. And for a lot of my career, I was basically a Silicon Valley technology mergers and acquisitions attorney, I would say. So I did a lot of buy-side mergers deals for big tech companies, like Facebook, Oracle, eBay, these types of companies. And I was in the mix, right? I was in the Bay Area. I wasn't a venture lawyer primarily, so I was more on the due diligence side, right? Like after a startup that was super successful, maybe one of my clients would like acquire it, and I'd have to find all the mistakes that the venture capital lawyers made in their rounds and stuff like that. But I've been in that. I was in that world basically, and I just got very interested in blockchain. Ironically, by doing the Facebook WhatsApp deal. Because the Facebook WhatsApp deal was, it was all about, a lot of it was about encryption and things like that. And so I got exposed to those issues, started researching encryption, and that led me to discover cryptocurrencies. And especially when I found Ethereum and the idea of smart contracts, I was like, oh, cool. So like automating my job away, that would be awesome. I got pretty obsessed at that point. And in 2018, I kind of took the leap into blockchain full time, right before the bear market hit. Perfect timing as always. And I've been doing crypto law, in one guise or another ever since then.
I love that. Any war stories from your VC review days that you could, legally share or anything there, or assuming most of it's kind of hidden?
Well, I think maybe the funniest was when, we were doing a deal and the partner, it was like the head partner on the deal was like a very important partner at the firm, very senior. He's on all the right ABA committees and all these things. And he really wanted to do the deal as an asset purchase. He wanted to do it that way the whole time. And of course, that's not as advantageous to the target, right? Because you get to like leave behind the liabilities in an asset deal. And so you kind of stick them with it. And so it was a point of contention, and we were doing it as a stock deal. And in doing the due diligence, I found some honestly, arguably fairly minor flaw in the way that they had set up these entities early on. But it was enough of a flaw where we could argue that everyone was entitled to the securities law remedy of rescission, meaning that they could undo the entire deal and get all their money back from the original investment and just destroy everything. And so, of course, he immediately seized upon this, and made it the reason why we had to do an asset deal. So it just shows you how fairly minor things can come back to haunt you. And there's a tendency for startups to be like, oh, we just need to get it done. And none of this stuff matters. And a lot of time that's true, honestly. But every once in a while, you'll have some weakness that you never suspected, and it'll be exploited years later, by some very OCD style, big law partner on a totally unrelated deal. So yeah, a lot of war stories like that.
When thinking about the deals you looked at on the traditional side versus the crypto side, I mean, it kind of seems like everything is different. But to your point, these deals close so fast that, people might not spend that much time on minute details when things don't matter. But, a week, a month, a quarter later, these projects are worth, hundreds of millions or billions of dollars. So this stuff starts to really matter.
Yep.
What's the biggest differences you see from there's a lot of paths we can go down here, and we will later in the podcast. But what are the biggest differences you see, I guess, from the legal side on projects starting in crypto versus your old world? Because like you said, a lot of these guys are just trying to close in a week or so.
So, yeah, I would say that the they're actually becoming more similar now, right? But they used to be very, very different. I mean, the idea of funding a startup through an ICO, which is basically like an IPO, and that was the dominant mode of fundraising, in 2017 and 2016. I mean, that would be crazy, right? It's actually that exact opposite in the traditional business world. You do a public offering when you're very, very mature, right? And you do a private offering, right, when you're very small, right? You raise from angels and VCs, so it used to be very different. Now it's much more similar, right? Because projects are raising quite sizable rounds from angels and from venture capitalists on a private basis. They clearly comply with securities laws at that stage because just limited to accredited investors, right, or just make it a non-public offering, and you can comply with securities laws that way. So in that sense, they become more similar to each other, but there still are a lot of differences, and I think that many people haven't fully processed all those differences. Like, for example, if you're raising for a traditional company, you're selling equity in that company, and that's all you're selling, right? You're not selling like 5 different types of securities to the same people, right? Because why would you do that? If you wanted 5 different features, you could just add them in the same security, which is kind of like what preferred stock is, right? It has a little bit of debt and a little bit of equity and, some voting and these things. But in these crypto rounds, most often it's a combined equity and token round, right? And so this leads to many very strange things, right? Because you're going to have all the same terms that you have in a traditional venture round with preferred stock. But then you're also going to have these token terms. What does it all mean, right? Because if you're, as a company that's selling stock, unless you're some type of like newfangled entity like a public benefit corporation, which still almost no one uses, you have a duty under the law to do what's called maximizing shareholder value, not token holder value, right? But on the other hand, you also are selling these tokens, right? And so it all works pretty well when your token holders are the same as your shareholders. But what happens when you launch this token out into the world, right? Or what happens when some of the shareholders own more of the stock than they own of the token because they sold some of the token? Well, now it gets very weird, right? Because you have this fiduciary duty to shareholders. It's kind of unclear what your duties are to token holders and whether all token holders are the same in that regard. Do you have a duty to every token holder or only to the ones who also hold stock? And it just gets very strange. And I honestly think it's like, the contradictions and the conflicts of interest are huge and like underexplored. So that's one dramatic difference, I would say.
No, that's a huge difference. I mean, is there an argument though that so you have the fiduciary responsibility to the equity side. Is there an argument though that these leaders also have to take care of the token holders because the token holders obviously underpin the security, longevity, incentives of the project, which then drive the equity? Or am I leaping too much here?
There might be some arguments, but they haven't really been litigated yet. So, there might be some sort of implied fiduciary duty, right? But no one's been held guilty for violating that fiduciary duty at any point yet, right? So at this point, I think most people proceed as if they have no duties to token holders as such, which I think is a pretty perverse result. And it's one of many catch-22s that we'll probably discuss, which is that like, the more clearly you assume responsibility for actually doing something for token holders, the more likely you are to get in trouble with regulators, ironically. And the less you do for them, the lower your regulatory burdens are, which makes no sense, but it is the case.
It's crazy. It's kind of like hand it off and you're in good shape, but your project's not in that case.
Exactly, right. Yeah.
That's tough. Yeah, no, I want to go a bit more into project formation, but I want to shift gears a little bit to talk about regulations that are kind of at the forefront.
Sure.
So there's a lot going on. Everyone sees a new tweet every day, Gensler this, SEC that. I'm not sure people understand like who the regulating parties are and what their powers are and what they're actually able to do. Right. Can you kind of dive into, I guess, what you see as the body that would most regulate crypto or have most of an impact and kind of where they're at right now?
Well, right now there's a little bit of a turf war going on in DC, I would say, on that very subject. And I think that suddenly, with the administration change and the Dems are traditionally pro heavier financial regulation. Elizabeth Warren has become very powerful, and she obviously is a career-long sort of heavy financial regulatory person, originally as a law professor. And so there's now kind of like a careerist scrambling to be seen as someone who is very good at being tough on crypto, because if you're perceived that way, you can get better positions and more authority and more power within the Democratic Party. And so there's a turf war where everyone is trying to get a piece of the pie at the same time. And the best way they can get a piece of the pie is just to, if they have the authority to do so, just start a ton of enforcement actions and investigations, right? And then, whoever does the most of that and starts winning will probably end up with a lot of power. So, currently the SEC is, I would say, carpet bombing the industry, I don't think they've gotten to the subpoena stage with many of them yet, but they're sending out what are called, voluntary, requests for voluntary information, right? But of course, if you get one of those, that they have, very strong subpoena authority and they could subpoena you. So you kind of might as well respond to those, very fulsomely. And so, there are a lot of investigations and conversations and, incipient disputes brewing already. And the SEC has definitely been the most aggressive. And what they will assert is, they will say, well, your governance token is a security. Or they will say, well, your smart contract protocol, if you think of something like an AMM, right? There are like thousands of tokens that are in that. At least one of them is going to be a security, right? Like, we won't even prove to you which one is a security. Like, we're just going to say, like, isn't it obvious that at least one is a security? And then therefore, aren't you running a securities exchange because you're involved in this smart contract and maybe like standing up a website, that lets people interact with the smart contract, or they will say, well, for, maybe like a protocol like Compound. And again, I'm not, anything I say here about specific things, don't infer from that they're like under investigation. I don't know. I have no idea. But like, for something that is like Compound or Aave or any type of like credit protocol, they will say, well, look, it talks about paying an interest rate. It talks about an APY and an APR. And it talks about borrowing and lending. Isn't this, a peer-to-peer lending platform just like all the ones that are registered with the SEC? And don't you have to come register with the SEC, right? Now, of course, these are analogies to the traditional financial world, and in my opinion, they don't exactly hold up most of the time. But those are the types of theories that they're asserting for why they have jurisdiction.
That's a good point. I understand the turf war. I understand why they would want to kind of carpet bomb to get as much power and kind of be the point person and kind of gain control. How do you view, though, I'm trying to understand, like, how do you innovate on the legal structure or what the government is okay with on one side while also trying to fit this in a box during a turf war, right? Like, you have a turf war, people trying to get control. They're trying to put, crypto into the old buckets that we had on the legal side for, the last 100 years. But on the other side, you also have like an innovation track, hopefully, where the government starts to get okay with this. They innovate a bit. How do those two coexist together, or do they not coexist together?
I think right now they don't coexist. I hope that they do at some point. But I just think that there's just a lot of initial skepticism and hostility. And I don't really blame the regulators for it completely because, I do think there's a lot of bullshit out there, right? There's a lot of people trying to like make something seem decentralized, but it's really not, and all the benefits are flowing to very few people. So I get their skepticism, right? But on the other hand, they don't really offer solutions, right? Like you couldn't, like Tom Emmer, had a good tweet storm yesterday about this and in his questioning of Gensler a few days ago, during the House oversight hearings. But even if someone wanted to say, okay, yeah, we think our token is a security, or like we think our smart contract system is a securities exchange, they couldn't go to the SEC and like to just do the proper registrations and have it all work. Like it wouldn't work. Like FINRA is not going to accept like a smart contract system or like just some team of software developers and like start treating them as broker dealers, right? And like broker dealers, they're like not allowed to like simultaneously custody securities and non-securities together. So like you would have to have like completely, like you couldn't have like Coinbase anymore, because it would be trading both like some non-securities tokens and some securities tokens, and like that's not allowed, right? So it's not like a path does exist where, you know, even if everyone was willing to admit that there were securities, they could just come in and make it work. And a few people did try to make that path work, right? Like Blockstack, and there was a project called Props, which I don't exactly understand what it is, but they did something called the Regulation A+ path, which is where you can you don't have to do the full SEC reporting, but you have to do something similar, and you get there's some transferability for the securities, but there are also limits on that transferability. But you could sell to retail, like you're not limited to only accredited, and it can trade, but it can only trade in securities venues, right? So so Props tried to do this, right, and they got the Reg A+ qualification, and they ended up shutting down like a month ago with a big announcement of how basically it was impossible for them to make it work well as a product while also treating the token as a security and doing the reporting. Because like every time that they would want to make any change to the system, of course, software is all about constant changes, they would have to go through basically a new qualification process. It just doesn't work, right?
That's crazy.
Yeah.
You know, I don't know the right way to phrase this question, so I'm just going to throw it out there and say that it's not my view. But, you know, when you look back at how this panned out, like Blockstack did a Reg A+ offering years ago. They spent a good chunk of their money at the time to do it before the token was, you know, worth a lot more. And then you have something like EOS that, you know, raised billions of dollars, and they kind of got a $24 million fine. So it kind of feels like it's in the project's best interest to kind of innovate and ask for forgiveness later. And this is obviously not my opinion or legal opinion, or don't go do this, guys. But, you know, I'm trying to get your read through here. It seems like everyone's in a better position if you kind of push the boundaries a little bit. Obviously, I'm not saying to do anything wrong, right, but what's your read through on kind of how that panned out?
Yeah, I mean, it's true. Yeah, I mean, people who asked for permission had to shut their projects down, refund all the money, and never do anything after spending a year negotiating with the SEC, right? And people who just did something became very rich. And that's because of the SEC has limited resources, and, you know, they're probably somewhat distractible based on where the political winds are blowing. And, you know, Clayton, when he came in 2017, initially he was like Gensler. He was like, all right, we're going to crack down on this whole thing, right? But after they got a couple wins under their belt, suddenly they kind of seemed to lose interest. Then suddenly there was that, you know, kind of out of left field speech about sufficient decentralization, which, you know, I like, but surprised a lot of people, and certainly didn't paint a clear picture of what people should be doing. And then there was just this kind of long period where, yeah, people could just do stuff and get away with it and get really rich. To their credit, you know, I think that this new SEC administration doesn't want to repeat that, what they probably see as being a mistake. And that's why that they are like engaging in, you know, an unprecedented, I think even, you know, I think it is deeper than what they did in 2017, early 2018, you know, of just really sending out so many letters and investigations and really rattling sabers. But at the end of the day, like, I don't know how it's going to go, because he might, like, if he works people hard enough to actually go after all of these projects simultaneously, right, then like he's going to be the most hated, you know, SEC chair, even by the SEC staff, because they'll be like so overworked, like they just don't have the resources. Like, that being said, you know, it's not like I want to just like exhaust the SEC stuff. Like you don't want to do. No one wants that. No one just wants to like roll the dice and hope that they're the project that's not enforced against. It should just be different. It should just be clear what they need to do, and what they need to do should be something that doesn't kill the usefulness of the project, and then everyone should just do that, and it should all work. But unfortunately, I think we're very far from that, and there's just going to be a lot of litigation and selective enforcement.
Yeah, no, I'm with you. Exhausting everyone would be annoying. And I do think Gensler's trying to help people in need that maybe need to get up to speed and to protect people. So I give him some credit there. If you had to give advice to Gensler on his, current path, what would you say? Like if you had an hour to talk to him and maybe to share your views with him, what do you think you'd probably spend the most time on?
Oh, well, I would say that they should, not focus so much on the enforcement actions and focus on creating a workable framework. And I think a lot of people have proposed a lot of interesting ideas on workable frameworks, some of which are I would say contradictory with each other, but to me, all that really matters is just finding something that works, right? Some people like Hester Peirce, who's another SEC commissioner, right? She proposed a safe harbor where basically she said, okay, there's a catch-22 here, right? On the one hand, we're saying if you're sufficiently decentralized, you're outside the ambit of the securities laws because there are too many different unaffiliated parties who are all contributing value, and no single one of them would make a lot of sense to make an SEC reporter in the issuer position. So we're saying that, but on the other hand, we're saying that a project can never get there because if the token is a security, then it's never going to become liquid enough while being compliant to actually have that level of decentralization. So her proposal was basically let's cut this Gordian knot, right? Let's just give people let's have them do a fairly simple disclosure, right? One that's not as tough as the standard that Apple Inc. has for its disclosures. And they can publish that. And then we'll give them 3 years, to get decentralized. They'll keep publishing occasional reports about things like insiders doing trading and things like that. And, as long as they are, sufficiently decentralized by that point, and there's no one really in control and it's, a thriving community, I'm paraphrasing heavily here, obviously, then, we'll give them a pass at that point, right? And the only thing that will remain is just the anti-fraud rules, right? If someone, says something, markets the token fraudulently, we're still going to be able to go, we, the SEC, will still be able to sue them for securities fraud. I think that's a good proposal. I think a more liberal version of Regulation A+ combined with some types of safe harbors for things like AMMs and saying those are not securities exchanges, so that, again, there could be the tokens might be treated as securities, but they could trade, at least in some venues, without breaking the law. I think that could also work, right? I think there are a lot of different things that work. The other day I proposed an idea. Well, really all we care about is whale abuse and insider abuse. Basically trading against the other token holders who have less information. So just adapt, what are called the Section 16 and the Section 13 rules that currently apply to public company insiders and public company whales and require reports like that. And leave the rest alone because no one cares about, do you care about Uniswap Corporation's financials? Why would you care about that? Even if you are a huge uni whale, I don't think you really care that much about, maybe you might want to know just their assets and liabilities or something like that, but it doesn't need to be audited by, a public accountant and have all their internal controls certified and stuff like that. And the reason why it doesn't matter is because it's not an equity instrument that relates to those funds, right? Whereas if you have Apple stock, the value of the stock is based on it being a residual claim of the assets of the corporation. And so it does matter there. So they could liberalize these rules, and they have done similar things in the past, for example, for asset-backed securities, and there's a lot of gray area around that. But that's what they should be doing. Instead of collecting thousands and thousands of documents from like software developers who sometimes don't even have entities and they don't even own the software. And sometimes they never even raise money by selling anything. Like some of these projects haven't sold a single token to the public, you know what I mean? And they've never taken capital in from the public. It's just kind of, you know, a bootstrap thing where the public liked the token and it became valuable, you know, and they had some of it and so on. It's just very different. And so that's what they should be doing. But sadly, I don't think that's what they're doing.
Those are really good topic areas for what they should be looking at. I mean, how does it play out though? Like, let's say, you know, hypothetically, they go after a few select companies, like you said, you know, selected enforcement, kind of lay the land. This is what you guys kind of can't do. If let's say they go after one of the big DeFi projects that they can, I guess the question for you is, one, where do they go after? Do they go after the founders? Do they go after the protocol level? Do they go after the UI? Like, what do they attack? And then two, you know, how does that pan out? Like, they don't obviously automatically win. I'm sure there's some type of case or procedure there, but you know, that with that give and take, where do you think they kind of end up at the end of the day afterward?
Yeah, I don't know, and I don't think anyone knows. There are a few different directions I could see it going. Number one, I mean, it's clear who they're going after. They're going after the software teams, right? And I think a little bit after venture capital funds. And they're going after them on the theory that, which is true, that they are greatly, it's sort of like cui bono, who benefits, right? Well, the software developers do benefit a lot, right? Because they do make a lot of money, and it's sort of paradoxical because they don't own the software, right? And they don't run the software, and they don't run any infrastructure. They don't own any infrastructure that the software runs on, right? Like, it runs on Ethereum. Miners run Ethereum, right? That those software developers have nothing to do with it. They're not miners, right? They don't own that infrastructure. And the smart contract code, other people could fork it, you know, usually under an open source license. And again, they would have no recourse. But nonetheless, they still are doing very well, right? That's undeniable. And so there's a natural tendency to say, oh, these guys are running this as a business. They're in control. They need to be responsible, you know, and we're going to find a way to hold them responsible, right? And they do often, they run websites. Websites aren't necessary for interacting with the smart contract, but they're certainly helpful, right? And they have branding, right? Some of these dev teams have like trademarked their branding and own it. So I get it, right? But but ultimately, I don't think it's the right way to go. So anyway, so they're going after these teams, and there are going to be some legal battles. The teams that are kind of like, I guess I would say Silicon Valley backed teams, you know, like they have a corporation and, you know, employees and all this stuff, and they like sold equity. I think they have an opportunity, I don't know if they'll take it or not, where they could most likely like pay a fine to the SEC, right? And then start going into like more of this like automatic finance route, right, where they, you know, kind of like Aave is doing, right, with its institutional fork of the protocol. You know, I think a lot of these teams could do that, and they probably would end up kind of like rugging the token holders in the process, right? Because I imagine part of the deal is going to be, well, you got to say that you're not going to be providing any efforts to make this token valuable anymore, right? You got to prove that. So. And so they would basically be rugging the token holders, but they would just say, oh, we always said it's this very limited thing. All it does is just decide how these other tokens are spent and doesn't do anything else. And by the way, Coinbase wants to buy us for $1 billion because we're really smart. Bye, guys. You know, I honestly think that probably will happen in at least a few cases. Now, what about others, right? What about teams that are like, they don't have an entity, they don't have venture capital investors? In some ways, they're more vulnerable because they don't have a backup plan, right? They don't really have supporters either, right? It's just completely dev run. And because they don't have an entity, a lot of these people might have individual liability, more easily provable anyway, and being more direct personal trouble, with regulators as opposed to being a director of a company and having D&O insurance and indemnification and all this stuff. So for those, I think that they will like increasingly go anon, operate in the shadows, so to speak, right? Have multiple passports, this sort of thing. And, they'll just adapt that way. And unfortunately, some will get in trouble, but a lot won't get in trouble. And again, just the perversity of it is that this will just lead to less transparency overall, right? And more shady people having a safe refuge, because now everyone's forced to act as if they're shady, even if they're totally honest, right? They still have to act as if they're almost like a criminal. And so it gives real criminals safe harbor. So it's just sad, but I think there will be this kind of bifurcated outcome.
That's super interesting. It's kind of funny that by having the centralized entity, you're able to pay the fine and move on somewhat faster than an anonymous group. I guess taking that a step further, though, let's say you are the decentralized DeFi project. You don't have the centralized entity to pay the fine. You're a founder and you drift into the shadows. You're still violating something, though, right? Because it kind of, I guess, in your example, the centralized company pays a fine because it does something wrong and it's going to make changes. But the decentralized company, even though the token can still exist and the project can move forward, they're still running afoul something that the centralized company paid a fine for, right? They're not off the hook.
Or I think it depends. I mean, I do think in some cases, based on the substance, those types of teams actually do have better legal arguments, right? Because there's no one like really dumping, right? Like if you think about like what is the registration process that Gary Gensler talks about? Well, it's something you do before you go public or IPO. Why do you need to do that? Well, as long as it's venture capital investors selling to venture capital investors, they're all assumed to be sophisticated and to have equal amounts of information and good methodologies for valuing things and so on. And so there's not a need for the regulation there. But when you go from that situation to, an IPO, right? And we saw with the WeWork thing, they weren't able to survive this because the valuation was such bullshit internally, right? That they basically weren't allowed to go public. But the reason why the SEC is there and this registration process is required is because, it enables these very sophisticated investors to dump on relatively unsophisticated investors. And so that's a situation where the government wants to protect people. When you're in a situation where there are no sharks, so to speak, who just invested money and are looking to flip it at a profit, and there are only builders. Yes, builders can still dump, and that is still a concern, right? But they put in sweat equity. I just think it's different. You know what I mean? And I think the policy concerns, maybe some of the same policy concerns are present, but they're present in a much different degree because, with this venture capital path, you can really pump something to an absurd valuation with the venture capital investors facing almost no risk, right? They just keep putting money in at these higher and higher valuations, right? But it's all kind of just happening on paper, and they might face very little risk. Whereas if something doesn't go through that cycle and it's just completely bootstrapped by the builders themselves, it's harder to fake a valuation, right? Because truly the public, is like discovering that valuation, and there's no one sort of like manipulating the books or like staging things for this like grand IPO where they can all dump. And so like my personal hope is that that at least some of those teams are not actually violating the regulations, right? Because they're not going through this traditional capital markets cycle that triggers people needing that level of protection. But hard to say whether regulators and judges, will ultimately end up agreeing with that or not.
That's pretty interesting. You opened kind of discussion here with kind of how there's been a pretty big reversal in when these projects raise money versus the traditional world. Like, traditional world, private money, then IPO. In crypto, it's kind of, public, then private. Do you see a good argument or do you see the government kind of accepting the new equality that we have? Like, instead of me buying, Uber when it's public, everybody can now get started and get invested way earlier, and it's kind of more optimal and kind of fairer. On the flip side, you don't have the diligence of a major bank looking through everything and making sure everything's kind of up to speed. What's your take there?
Well, I think it depends on the circumstances, right? Like if you look at a fair launch, right, like Bitcoin, or arguably fair launch, right? As people debate these things, so it's always, always a problem, right? But I consider Bitcoin a fair launch, or I consider like Urine, for example, a fair launch, right? Because there was no, the Andre Konya could have taken like 60% of the token supply or something, and like he took like none of it. Like in that circumstance, I don't see how they can sort of complain, right? It's like the ultimate fairness. Now, of course, like the downside of that circumstance in its extreme form is then you have people who, it's like unfair to the builders, right? Like they did a bunch of work and they're making a bunch of other people rich from it, not themselves, right? So like that's not a great outcome either. They will, I think until they lose some court battles, they will just see the fact that there are people who started this, right? And there are people who came into it later, and it wasn't sold to them as accredited investors. Now there's the liquidity mining thing, right? I mean, that's the other element. Like really you say investing, but people are not, generally speaking, they're not investing, right? They're getting it as users of the platform. Right. Now, are they using it a little bit more maybe because of this token thing and that it might become valuable? They probably are. Right. And does that mean that's an investment of money? Maybe, but they're not really committing capital. They can pull themselves out of the liquidity mining at any time. And, I just think there are a lot of debates there. Like we're really at the border, right, of where like do these people actually need protection? Like what is the risk that they're actually facing? Because as you'll find on Twitter, most people just feel like they're getting a lot of free money. I guess the risk is that it creates a market, right? By doing this, it creates a market, and then eventually someone will come in who actually is taking a risk, right? Because instead of like getting the token for free through liquidity mining, they're like buying it from someone on Coinbase. And even though that money is not going to the software team, that person is still taking a risk of some kind, and they want to make sure, that person is protected somehow. But I don't know, can't protect. There are always costs protecting people as well, right? To protect that one person, at the cost of like everyone else losing the opportunity as a user to own the product that they're using and get upside with almost no risk. It seems a little crazy to me from a policy perspective, but I don't know that regulators see it that way. But yeah.
No, it's kind of funny to think about. And the other question I had for you there is, how much do, you mentioned people on Twitter, like they just care about making money. Like how much do Americans' voice and like actually matter in all this, right? Like this is like a much probably broader question for you that I don't want to go down every path here, but people missing out on a multi-million-dollar DYDX airdrop, I think it's worth a couple million at this point, or maybe over $1 million. I haven't checked in a while, but like that just pisses people off,
sure.
Right? Like, I mean, when does people's voices get loud enough to actually influence this decision, or is this just too like utopian of a question on my part?
No, I mean, I definitely think it matters, right? Because we can see some politicians are seizing on the opportunity, right? Like Emmer, and even who was it? DeLong, I'm forgetting, but like not DeLong, but there was like basically like during the debate on the tax bill, as well as like these recent SEC things, some politicians are like, hey, this is a good opportunity for me. I can get donors who care about this issue. Obviously, crypto people have a lot of money, right? They can spread it around. And I can make this part of my platform. I can maybe get some of the youth demographic, right? And the more politicians who see an opportunity there, the more they will push on the regulators, to go lighter or be more rational, and there will ultimately be progress. But right now, that's going to take a long time to play out, right? It's like a generational thing. Like boomers will die off, and we'll take over, right? But right now,
the new generation.
You've got the Elizabeth Warrens of the world who are just like, I'm sure her motivations are sincere. She just sees it all as kind of the same thing, right? Predatory CEOs are the same thing as like shadowy super hackers, are the same thing as, God knows what, right? And they're all just out to like exploit the working man, right? And manipulate the markets, and we got to protect them, and I get that, but I just don't think it quite applies the same way to,
that seems like such a propaganda of a line. I feel like that would be in a commercial in some, scary movie.
Exactly. And it's like, and I just don't think, like, she's like, yes, at a sufficient level of abstraction, it's all the same. But like the reality is, like, Enron was an SEC reporting company. It was one of the biggest frauds of all time, right? Whereas all these systems, are they perfect? Are people like completely safe? No, of course not. But it's all on chain. Like everyone can see the risk. Everyone can see the code. And it's just like the fact that there's some risk to like focus so much on that area when you have like the Madoffs and the Enrons that happen right under the SEC's nose, and then just say, oh, the SEC is the cure for this problem that hasn't even happened yet with these systems. And so like we just need to crush it all. It just makes no sense. I mean, it just makes no sense.
No, I'm with you. It doesn't make a lot of sense. And, building on that point, like, what do you think that the regulators that are super against it care about, right? Like, do you think that they care about, crypto undermining, the US dollar and, degrading, us as a country's kind of global power? Or do you view this as, hey, we want to protect our, TradFi friends who have big companies who are getting disrupted by this? Or do you think it's more of just, like you said earlier, like a power grab, kind of in a place of ignorance a bit? Like I always get asked this question from friends, like, why does the government hate innovation so much? And I'm like, I don't always have a great answer for them. So I'm not sure which bucket you kind of fall into there.
Well, it's sort of, I'm sort of like, I read a lot of like Foucault and Nietzsche in college. And so like, I'm a big fan of this idea of like a conspiracy without conspirators. Like, basically, like at a certain level, like all these people just have a job, right? And like you have a job and like you just do your job. And some people might get philosophical about it in their spare time, but it's like, I'm an SEC staff. These securities laws exist. They're defined very broadly. My job is to enforce them. Some politician is like yelling at my boss, like, because, she thinks like it's all like very risky, right? So like, I'm going to go out and I'm going to do my job, right? Like at a certain level, I just think it's that simple.
Well, Gabe, to your point, does it make sense that like, people like me, even with my question, are just like simplifying what is just a massively complex machine of just people going to work every day? I mean,
I kind of think so. Yeah. We're just all caught in this like matrix, right? And it's just like, I'm sure like there's some like SEC staffer who like thinks what he's doing is so stupid, right? But like he has to do his job. And some days I think what I'm doing is stupid, but I still do my job, right? It's just kind of like what it is.
Yeah, you mentioned something during your discussion. I don't want to interrupt, but you mentioned when we were talking about the difference between, the more centralized projects and the more decentralized ones, you mentioned the idea of personal liability, which I think is something that most people don't really understand well. They just, release code, and I'm glad they do. It's a ton of innovation. But the idea of personal liability for launching a project is pretty massive. What exactly is that? And do you think people understand how much they could be on the hook for here?
Yeah, no, I think people didn't take it seriously until recently. And in part, there's good reason for that, because traditionally, the act of writing and publishing software just hasn't been considered a high-risk activity from a legal perspective before now. About the closest we ever got to it maybe is like something like Napster, right, or like Mega Upload, right, and that's a distant memory for a lot of people. Or in the case of many young people, like 20-somethings who were writing DeFi contracts, they didn't live through that era, right? It's tricky because there's not one answer. And it works differently under different regulations, right? But, the basic idea that we have in most civilized nations that if you form a business entity, right, and you capitalize it sufficiently, and you do things through that entity has legal personhood, and it is treated, if it's breaking the law, then that entity is the lawbreaker, right? And that entity might have to pay a fine, thus placing its capital at risk. But the individual shareholders and managers, they usually aren't guilty of violating the law, even though they sort of like caused the entity to violate the law. Now, so like in the general case, right, like if there's a securities law violation that's non-fraudulent, usually just the entity would pay the price. The problem is that, well, two things. Number one, there's also secondary liability, right? So like if you aid and abet the entity violating the law, which requires that you sort of like knowingly cause it to violate the law, right? Then you could be personally liable. So that's like the theory in the Ripple case, right? Of like why Brad Garlinghouse is a defendant. So that's always a possibility, right? The other thing is that, entities are not a complete shield. Like if you don't actually treat the entity as a fully separate thing, you don't do all the board meetings, or like when you minted the token, you didn't like pass a board resolution that says, this corporation is minting these tokens and distributing them here and here. Then, or like you also have these weird multi-sigs, and like the relationship of those to the corporation is like pretty unclear. Like some people who are on the multi-sig work for the corporation. Others are just like random people from the community. Now you are, even though you have an entity, you are muddying the waters, right? And, it is possible through a theory known as veil piercing, or through various other types of allegations, to hold the individuals liable for violating the law. And then there's kind of like also an overlay of like, if you go look at the Delaware Corporate Code, for example, it says a corporation can be used for any lawful purpose, right? So if you're not using it for a lawful purpose, then you probably shouldn't expect that limited liability will be honored, right? So it's not so much, I think people fetishize in both directions. Some people are like, having an entity doesn't matter at all, which is obviously false. And then other people are like, oh, I have an entity, I'm safe. Neither of those things is true, right? You have to really think about what you're doing and the way you're doing it, and what society has to say about responsibility, right? And look at the specific laws, to see what your personal exposure is. But a lot of people have personal exposure.
It kind of sounds like it's pretty obvious if you know that you're doing it the wrong way. As was kind of my opinion with most legal things, like, if you're screwing up, or if you're kind of, if you have an entity and you're obviously not putting the time into it, the board meetings, separate bank accounts, right. You kind of get it at that point.
Yeah. Agreed.
Gabe, switching gears just to kind of close out the discussion, no rush, obviously, but just a different topic area. USDC has obviously been talked about a lot. I mean, people saw that Circle got a letter of some kind, and they've been talking with the government for a couple of months now. Obviously, USDC as a stablecoin is plugged in from everything from how, VCs like us fund deals, to yield farming, to just stable payments. It's billions of dollars in issuance. I think it's 41 billion or maybe higher. I got to check. But there's been a lot of discussion on how the government may go after Circle or USDC, if they even will, and I guess the effect of that, and if people should switch to a different stablecoin like UST or others. I was wondering your take there. I know it's a broad question, but I want to let you take it whichever way you want.
Yeah, so I am very surprised that stablecoins have gotten as big as they have. I remember, discussing with some prospective clients back in 2017. They had some ideas around doing stable coins, which maybe they hate me forever because maybe I talked them out of them. But, I just thought, how can this ever really be a thing? Because for better or worse, most economists who are influential or have power, like Paul Krugman, for example, they don't believe in sort of like the Bitcoiner type of like monetary theory. They believe that it's a good thing, and it's like an essential, it's like one of the most important things in the world, that the government be able to manipulate the money supply basically at will, right? And they think this is extremely positive and extremely valuable. So if you believe that, and in some sense, I mean, who knows? We might have another like Weimar like hyperinflation. It might happen. But on the other hand, we survived this COVID thing pretty well, right? We've survived some other things, even the whole Lehman Brothers thing, it caused some problems, but like they were able to bail it out, and it kind of worked. like it could have been much worse. We didn't have another Great Depression. So like, I'm not as like skeptical, as some people about that. I'm more open-minded. But whether you agree with that philosophy or not, you just have to know that most people in power think it's a great philosophy. And so if you have this stable coin out there, right, when that reaches a sufficient scale, that will adversely affect the ability of the Fed to control the money supply at will, right? And so, of course, they're going to hate that. They're going to view that as like one of the top existential threats to markets, national security, everything possible, right? So regardless of like technical, we can talk about technical arguments as a security, blah, blah, blah. They just don't like it. They just don't want it, and they want to get rid of it, right? And I understand the reasons why. And it's not surprising to me. It's more surprising to me that it got this far, I guess I would say.
Isn't USDC, though, kind of an extension of their power in a sense? And I'm far from the macroeconomics, macroecon on our team, but like, wouldn't like a plethora of USDC within DeFi and globally just help their reach because they're able, our
Right.
government's able to manipulate the underlying, US dollars.
Right. Yeah. I mean, there is that argument, right? It's like, it's kind of like, well, isn't it a good thing if everyone's using digital dollars, right? And do you really want to cede that over to like China or something to make their, digital yuan? Because if USDC is the best digital money stable product and everyone starts using it, that'll be an extension of U.S. hegemony, right? And I personally, if I were in power, I probably would see it more like that, right? But they're not saying they don't seem to be seeing it like that. But I agree with all that. Yeah, it's weird.
No, it is weird. If they were to go, let's say the government goes after Circle for USDC, and I'm not saying they will or they won't, but if they do go after it, what do you think the effects will be on DeFi? Do you think people just transfer USDC to another asset and good to go? Or I'm assuming if the government wanted to effectively go after USDC, they wouldn't allow some grace period for people to move out of it. But
yeah, I don't know what they would do. I would like to think that they would try to unwind it gracefully, and minimize the harm. But I just don't know. My personal guess is like, I think Circle, is backed by the right people, and of course, it has this Coinbase relationship, and which is now a public company. I don't think it's going to get destroyed. I just think it will have to, become more regulated, right? And some of the others, might get destroyed, right? And there's no real rhyme or reason to that because I think Tether and USDC at this point are basically the same as far as I can tell. They both have this short-term commercial paper supposedly, and they're both like, we don't really know exactly what they hold. So like, I don't really think they're that different, but except that one, like maybe made better political bets, it might be safer for that reason. But I don't think it'll go away completely, right? Because it's too useful, right?
No, I'm totally with you. And I'll phrase this question because I know you're working on a lot of amazing stuff within Delphi that we can't totally disclose right now. So I'll lob this as a dumb question over to you. But, UST is obviously an alternative here. And you guys are building within Labs basically around the entire ecosystem there on that foundation. Do you view it as, I guess, a better option regulatory wise, or I guess, how do you view the comparison? And I know I'm acting dumb here, but I want to get your view.
Yeah, sure. So, well, I think, I think the purpose of these technologies, like what can be regulated will be regulated, right? And obviously something that's collateralized by an institution, with like a business entity and holding like bonds and stuff like that, that thing can be more easily regulated than something like DAI where all the collateral's on chain, or something like an algorithmic stablecoin, like UST, where, it doesn't have any backing at all. Right. And so I'm always like, I think it's very important to keep pursuing these solutions, but there's always the question, like, why is USDT and USDC, why are they so huge? Right. It's because it's very easy to scale things on a centralized basis. It's very hard to scale other things, and they're like still experimental. So like, I definitely think UST is going down the right path. And I think it's like one of those things where if it can scale it'll be great because even if let's just say for the sake, I don't think it is a security, but let's just say for the sake of argument that it were a security. They were definitely a security, right? Still, it's just going to be very hard to shut down, right? Because it just depends, like all the arbitrage that holds the peg could just move to like DEXs and stuff like that, or they can move to like offshore exchanges where the securities rules are different, and people could like keep maintaining the peg, and people could keep using UST. So from that point of view, it's pure. I don't know whether it can scale sufficiently, right? But that's why we're building. That's why we're building on Terra, because if there's a lot of demand on the Luna side, right, and there's a lot of demand on the UST side, that's sort of like extrinsic, not really speculative, but like merchants who accept UST and people who want to pay for things in UST, as well as people who, I suppose want to either like do governance through holding Luna, or even just speculate on the price of Luna, then the more external drivers of that there are, the more scalable it will be, right? And ultimately, yeah, maybe that could become very, very robust and a usable alternative.
No, that's a really good take. Gabe, I have a couple of faster questions for you to respect your time. I have one potentially longer one for you we'll close out on. But, formation within crypto projects is hard. Sometimes I laugh at some VCs and they say, hey, we'll just, we'll copy the safe and the warrant, we'll change the name and the amount and the entity,
right.
Make a few edits and we have our legal docs. It's rarely the case. What do you think is the optimal formation for a token project? Like DAO first, you prefer safe and warrant, SAFTI? There's so many different ways to form this, and there are a lot of dependencies here, like if you have an entity or if you don't have an entity and you're going to issue a token or you're not going to, there's so much to go back and forth on here. And I know you're personally innovating in this a lot, and we could talk about that on a future podcast. But I guess right now, without talking too much about what you're doing on the innovation side, what do you think is the optimal kind of structure legally for a token company to kind of form?
Well, there isn't one optimal structure because there are catch-22s, right? So it depends on the values of the people involved and what they want to prioritize, right? If what you wanted to prioritize is having the least likelihood of your governance token being a security and like things like that, and like your DAO, quote unquote, being a general partnership, then you probably would do something like Uniswap or like DYDX or these types of companies where like you just define like very, very thinly what the token is. You exclude, you try to make some efforts at least to exclude U.S. persons from receiving the token, or maybe even like using the smart contracts through your website, and this sort of thing. And all the revenues continue to flow to some corporation, right, that you just completely own. Personally, although like that may be arguably like have the best like securities law defenses, I actually think it's the most unethical, right? Because people they just won't accept the idea that maybe this token is just almost like close to totally useless. Like they're still going to give it this value and be buying it and stuff. And that's going to give these insiders a lot of exit liquidity that like maybe they don't really deserve, right? Because like why is this token valued so high? Like I just don't get it, right? Like no fees flow to the token holders. It doesn't decide anything. The same team could produce the new version and they could say, yeah, this version, like it's actually governed by some other token, right? Or like no token, right? Like they could do that, and they've never said that they won't do that. So like these valuations are kind of absurd for those types of tokens, but that is probably legally like the safest thing you could do. On the other hand, if you want to say, no, like I want to make sure that this makes sense and that people are treated well, right? Then I think you go in the exact opposite direction. All of the value goes to the protocol, to the DAO, to the token holders, right? There is no equity. There's no separate equity. There are no conflicts of interest. Everyone is 100% aligned on the token, right? And in terms of, and so you got to bridge to that, right? So like in our case, for example, we have these like joint ventures, and basically everyone who's getting the token is like building the thing, right? There aren't any like really external investors, so to speak. And I think that that's a good philosophy if that's what you're pushing, because there is this idea, under the securities laws that if you have, what's called a partnership, right, that the interests in that partnership are presumptive non-securities. Why? Because every person is putting in their own efforts and responsible for their own efforts, right? They're not relying on the efforts of others. And you don't want to be a partnership necessarily, but if you're partnership-like in that sense, where everyone who has this token and is getting value is also giving value and personally responsible, there's also a good argument that that should be outside the securities laws for very different reasons than under the other set of projects that I talked about. So those are kind of the two main themes, I would say. Very, very different, and only litigation and further developments will tell which one fares better, or however you want to put it. So we'll see, I guess.
No, that's fair. And I guess on the structuring, I think what we've seen in the space is there are some really solid external law firms out there, right? Like I'm not going to name any specifically. I don't want to play favorites, but there's also kind of not that many solid lawyers who both understand crypto and I guess have the incentives to leave a cushy job and to dive in and take the risk, et cetera. Obviously from a finance background is worth the risk reward,
right.
But not everyone has a Gabe Shapiro in their project, right? Like not everyone knows, where the lines are that you just drew in the sand, to go after that. Is there anything that other lawyers in the space can use to get up to speed to follow, what you consider to be best practices? Because in my opinion, it's great for, Delphi, candidly to have someone like you here, but I want to help the entire space move forward and to know how to do this in the best way too. What would be your advice there?
Well, yeah, I think that that's why I write a lot and tweet a lot, and I'm in like millions of Telegram groups, and we started this like sort of DAO-like thing called LexPunk, that got some funding from Curve and Yearn and Lido, which is great, and we're going to do more there to kind of try to pull more lawyers in and get everyone talking to everyone. But I think that's what you have to do. You have to talk to people and try to work more like a developer, right? Open source your own work product and hope that inspires other lawyers to open source theirs and collaborate. Very, very hard for lawyers to do this. Lawyers hate doing this. It's like culturally completely against the grain, but there is so much to figure out. And like, sure, of course, it's always nice to hear I'm so knowledgeable and all this, but like, I'm figuring this shit out every day. You know what I mean? And like, there are things I said a year ago that I would think are like absolutely idiotic now. Right. And there's just so much to do. And, it will only evolve if like people kind of put their egos aside and like all start collaborating on stuff. And unfortunately, it's still very antithetical to law firm culture, right? Because law firms want to say, "Oh, we're the best, we understand the most." We don't want to share our firm with them. They'll take business away from us, right? And that's why it evolves very slowly, unfortunately. So I would say, yeah, if you want to get into it, like you could hit me up, or there's other people you could hit up. Find us on Twitter, join Telegram groups, join forums, talk a lot. Talk to regulators, talk to each other, talk to your clients, get your clients to talk to other people's clients and collaborate. And, then we will make a lot of progress.
Gabe, do you think it, just like the traditional kind of how developers have been disrupted in crypto, right? Like instead of going to Google for 4 years and making, $500K to start a crypto project, doesn't this also kind of disrupt the traditional legal model where you have like 500 associates? Like why the hell would I want to grind as an associate, just like grinding on Wall Street and finance, when I could just go, crypto full time? And I'll preface that with, I personally learned a ton of Wall Street. I wouldn't take it back, but
right.
Kind of begs the question though.
Yeah, no, I agree with you. I think it's a tremendous opportunity for young lawyers who are smart and understand technology and don't want to have, what I call a 10-year cliff on their investing their equity in a law firm, right? Because you could jump into one of these projects and you could get a token grant and give them legal guidance, and you could do very, very well. There's some ethical issues around that, but all this will be figured out. And the people who took calculated ethical risks, will like in any area, they'll get an outsized portion of rewards. So I agree with you. And every time I see anyone, I say maybe do 1 year in big law or something like that, and then get out of there and join a project, right?
I love that. Gabe, I'm excited to have you on for more episodes. There's a lot of different areas we can go into. We'll cap this one at an hour, a little over, just that I get back to work. But Gabe, thanks so much for coming on, man. I know we covered a lot and I really appreciate your time.
My pleasure. Anytime.